Toronto has issued a heat warning. We've got high temperatures melting our city. Hot and humid conditions expected today, with daytime highs reaching near 31 degrees Celsius. We've got David Burrows back on the line. He's Chief Investment Strategist and President at Barometer Capital Management. David, great to connect with you. What is the most important thing in the markets we should be paying attention to right now?
Look, I think that we've had a very rapid adjustment over the last 2 months to the Fed's hawkish policies and to the concerns around inflation. And we really have discounted a slowdown in the economy. We've discounted higher rates. Of course, the thing the market really cares about is the trajectory of inflation data. If we get data that shows a slowing in the rate of inflation, then people can start to look through to a Fed that becomes a little bit less hawkish. From a positioning standpoint, people are already very, very defensive. Portfolio managers have lighter positioning than they've had since 2002, and there's all kinds of hedges in the market. So when we look at inflation data like the CPI data today, we're looking backwards, and we want to look for pieces that start to show some kind of a cooling off. And we got a little bit better numbers on food and housing in this Canadian CPI data. What the numbers are really not taking into account is that we've seen a pullback in energy prices and commodity prices over the last month. And we have to remember that the market is not linked directly to the business cycle. It's looking ahead 9 to 12 months. Mm-hmm. And so a lot has been discounted in, and it's important for people not to get too bearish. The thing that everyone worries about is a 2008-9 scenario. Mm-hmm. But the difference there is that was a recession that turned into a credit crisis. And at this point, there is no indication of a credit crisis. Where you go from a 25% correction to a 45 or 50% correction is when you move into a credit crisis, and there is no sign of that in the market right now.
That's interesting, because back in 08, 07, we were wondering, is the financial system itself going to fall apart?
Right. And there are very clear indicators that we can watch. For instance, the spread of excess return that a corporate bond investor or a high-yield bond investor expects above a government bond. And while the spreads have widened, it's not anything like even 2020. Let alone 2008. So, look, markets are discounting a recession. We probably got to extreme levels in June in the market in that unwind. We're into a summer rally. Even for a bear market rally, what's happened so far is minimal. We likely would see, another month or 6 weeks of a bounce. And it's possible that if earnings estimates come down over the next 30 or 60 days, we could have a little bit more weakness in the fall. My guess is that might retest the lows from June. Mm-hmm. But we're in a bottoming process. And unless something gets significantly worse, we've probably seen the worst of it for the broad market.
David, when it comes to your own portfolio positioning, you like staples, you like utilities, and you're also relatively keen on energy and materials.
Yeah, we really have a barbell approach, because our view is that while we are in a tactical pullback, we've started a secular bull market for reflationary assets, and we've talked a lot about that over the last year. So in the near term, we have to have some defensive positioning, because people are looking for an alternate source of yield to the bond market. And so dividend growth stocks and high dividend stocks like utilities and consumer staples that can give us dividend growth look attractive. But on the other side, while there's been a sharp pullback in energy, we have a structural problem in the energy market, and energy stocks are really only discounting sort of $65 oil. Mm-hmm. And we think that there's lots of upside in that part of the market.